Welcome to the Deep Dive, your essential shortcut to understanding what truly matters in the latest market moves and corporate calls. Today, we're cutting through the noise to bring you the key insights from Gap Inc.'s fiscal second quarter 2025 performance. That covers May through July. You've got the raw data, and we're here to distill the most important nuggets, connect the dots, and give you a clear understanding of what's driving this iconic retailer.
It feels like, well, a multi-front battle.
It really is an absolutely fascinating quarter to unpack, marked by a really interesting divergence, I'd say. We're seeing strong brand momentum across, much of Gap Inc.'s portfolio. But at the same time, it's grappling with some significant and frankly unforeseen external pressures. We'll explore what the numbers truly tell us, what management's strategic playbook looks like, and importantly, what they're doing to navigate these headwinds. That's right, because on the surface, the market reaction has been what we'd call cautious neutral. Almost like a shrug, really. But dig just a little deeper, and there's clearly a battle happening beneath the surface. So let's start maybe by looking at those headline numbers that really caught our eye. Gap Inc. reported GAAP earnings per share of $0.57. That actually edged out analyst expectations by a couple of cents. Revenue came in at $3.73 billion, largely in line with forecasts, indicating essentially flat net sales growth year over year.
Yeah, and what's particularly insightful here, and maybe the first signal of those external pressures, is the gross margin. It saw a 140 basis point decrease year over year, landing at 41.2%. And this wasn't just, a simple dip. It was influenced by two main factors. First, the company was lapping. That's the term they use, a significant credit card benefit from the previous year.
Ah, right. So a tough comparison.
Exactly. They were comparing against an unusually strong period last year that had this sort of one-time boost, making this year's comparison inherently tougher. Second, there were incremental actions taken to support their Athleta brand reset, which involved some, let's say, heavier discounting to clear inventory. Despite these pressures, though, the operating margin finished at a respectable 7.8%.
And the market's initial dance around these numbers was quite telling, wasn't it? There was that immediate dip in after-hours trading right after the call, signaling some maybe knee-jerk concern about those margin pressures. But what's truly interesting is that shares managed to stabilize, even gain slightly by the next market close, albeit with elevated trading volume. This suggests that while the market is certainly aware of the challenges, it's also perhaps seeing that underlying operational strength management is emphasizing. It's that cautious neutral sentiment we talked about, a kind of a delicate balance between strong operational execution and those macro challenges. This really raises a crucial question. What were the specific underlying drivers creating this mixed picture? And how are the individual brands contributing to this broader, complex story?
Absolutely. It's a tale of, very distinct realities playing out across their brand portfolio. We're seeing some genuine stars in their stable, but also a significant drag that requires close attention. Let's really pull apart what's working and what's becoming a major hurdle, starting with where they're finding that success.
That feels like the right place to begin. Because looking at the brands themselves, this quarter marked Gap Inc.'s sixth consecutive quarter of positive comparable sales company-wide. That's a significant streak, right?
It really is.
Old Navy, their largest brand, delivered a strong 2% comparable sales increase. And that's building on a robust 5% comp from last year.
Yeah.
And get this, they saw their highest volume second quarter for denim in a decade.
Wow.
Yeah. And their active business also continued its impressive growth trajectory, fueled by a major campaign featuring none other than Lindsay Lohan.
What's truly insightful about Old Navy's performance is how they're achieving it. Many retailers, when facing challenges or aiming for growth, they just pump more money into marketing or store spend. But management highlighted they're becoming much more efficient and effective in their merchandising and storytelling.
So not just throwing money at it.
Exactly. They're not just throwing money at the problem. They're leveraging what they call their playbook to build genuine category leadership, particularly in denim and activewear. This isn't about short-term fixes. It's about a deep understanding of their core customers' needs and delivering against those efficiently. It's a lesson maybe some of their faster-growing, digitally native competitors are still learning, that fundamental product and messaging can be incredibly powerful.
Okay, so if Old Navy's story is about consistent execution, then the Gap brand itself, well, that sounds like a powerful reinvention. It delivered its seventh consecutive quarter of positive comparable sales, up 4%.
7 straight, yeah.
That means sales from stores open at least a year are growing. That's a critical indicator, right, of underlying brand health,
Yeah.
genuine customer resonance, not just opening new stores.
Definitely.
This was clearly driven by bold product ideas, culturally relevant storytelling, and remarkably consistent execution. Their Fall Better in Denim campaign, featuring Katsi, generated an incredible 20 million views in its first 3 days.
20 million.
400 million total views. And an astounding 8 billion total impressions. It became the #1 search on TikTok. But here's the real kicker. Average unit retails are up, even without their collaborations. That shows broad-based strength.
That's a powerful statement about brand health, absolutely. When your average unit retails are climbing, it implies you're selling products at higher prices. Could be stronger demand, less discounting, maybe improved product mix. It's a fantastic sign of pricing power and perceived value. It suggests the core product, the narrative, it's resonating deeply.
Right.
And it's not just the Gap brand. Banana Republic also showed positive momentum, a 4% comparable sales increase there, reflecting solid progress in its premium repositioning.
Okay.
They're seeing improved consideration, encouraging growth in new and reactivated customers, particularly with positive trends in women's bottoms. So it indicates their refined aesthetic, the focus on quality. It's truly taking hold with a, discerning customer base.
So we have 3 brands executing their playbook brilliantly, showing strong momentum. But, every story has its challenges. And this quarter, for Gap Inc., that challenge was Athleta.
Athleta.
It was a tough period. Comparable sales down a significant 9%, net sales decreased by 11%. The core issue, as management pretty candidly described it, was a misfire in the product assortment.
Yeah.
It simply wasn't aligning with customer expectations, leading to higher discounting to clear inventory. It's a tough lesson for any brand.
Yeah.
Just because you build it doesn't mean they'll keep coming if the product isn't quite right.
Indeed. And this prompted a decisive move, one that really underscores the urgency of the situation. Maggie Gower, a veteran leader from Nike, over 2 decades of experience there, most recently leading their North America women's business.
Okay, a big name.
A very big name. She was appointed as the new president and CEO of Athleta in late July. Her background in women's active sport and style, coupled with extensive experience in retail strategy, merchandising, it's clearly aimed at a purposeful reset year for the brand. The focus is laser sharp, lowering inventory, tightening the product mix, and crucially, returning to its distinctive performance roots to better resonate with consumers.
So a turnaround story to watch.
Definitely. This isn't just a leadership change. It's a critical turnaround story we'll all be watching very closely. How does she reestablish that connection with their core customer?
Okay, turning now to the broader financial outlook. And the big macro factor that became, a central theme this quarter, tariffs. Gap Inc. reaffirmed its full-year 2025 net sales outlook. Still looking for a 1-2% increase, which shows confidence in sales momentum. However, they updated their operating margin expectation downwards to 6.7% from 7.4% in fiscal 2024. That's a notable revision.
It is indeed a significant cut. And the main reason for that revision, according to management, an estimated net tariff impact, roughly 110 basis points on the full year operating margin. That amounts to a substantial $175 million.
Wow.
Yeah. These are primarily from new trade policies that became effective in August. Management explicitly stated that without these tariffs, they would have been expanding both gross and operating margins in line with their original expectations.
That's a really important point.
It is. It's a powerful statement about their underlying performance. It suggests that the core business, on its own terms, is actually quite robust. The tariffs are a significant external headwind, not really an internal operational failure.
So what does this mean for mitigation then? Are they just going to absorb this hit, or are there proactive steps they're taking to soften the blow? And could these steps maybe even turn into a long-term advantage?
They're certainly not just absorbing it, they're acting strategically, very much so. They're aggressively diversifying their sourcing network. The aim is for China to represent less than 3% of sourcing by year-end 2025. Less than 3%, that's a huge shift.
Huge, and no single country exceeding 25% by 2026. This move isn't just about tariffs, It's about long-term resilience, reducing country concentration risk in their supply chain.
Makes sense.
They also anticipate significant technology investments in the second half of the year, improving efficiency, customer experience, including leveraging AI in demand planning, supply chain, even in everyday workflows.
AI, how so?
Well, think about AI helping them predict what styles will sell best, maybe optimizing inventory placement, even streamlining communication with suppliers, that kind of thing.
That sounds like a long-term game plan for sure. But how quickly can they actually pivot on something as complex as a global supply chain? That takes time, right?
Oh, absolutely. It's a multi-year effort, but a crucial one. Importantly, the company does not expect the annualization of these tariffs to cause further operating income declines in 2026.
Okay, so they see a path through this. Exactly. In fact, they aim to mitigate the full impact over time. They even hinted at potentially returning to a double-digit margin in the long term. This implies significant underlying strength once these tariff headwinds abate. It sets the stage for future margin improvement opportunities as their diversification efforts mature.
Gotcha. And for Q3 specifically?
Right. For the third quarter of 2025, they're guiding for net sales up 2.5% year over year, driven by strong back-to-school at Old Navy and Gap. However, third quarter gross margin is projected to contract, or delever, as the jargon goes, by about 150, 170 basis points year over year, with tariffs alone having an estimated 200 basis point impact. So more than offsetting any underlying gross margin expansion they might have achieved otherwise.
Ouch. So the tariffs are really biting in Q3.
They really are.
And what about inventory levels, especially with these accelerated receipts and higher costs? Are they sitting on too much product?
Well, inventory was up 9% year over year, largely due to those accelerated receipts and higher tariff costs, in anticipation of the new policies. However, management assured analysts they ended the quarter with the right inventory composition, meaning the products they have are aligned with customer demand, apparently not just a pile of unwanted goods. They're also proactively tightening unit purchases for the rest of the year to ensure flexibility, positioning unit purchases below sales, which is a smart move to regain control.
Okay. And shareholder returns?
Still committed. They maintained their dividend of 0.165 cents per share and repurchased 3 million shares for $82 million in Q2, which is a strong signal, right? Confidence in their balance sheet, commitment to returning value, even amidst these challenges.
So if we step back, you're hearing a story of robust brand execution, a strategic playbook that's clearly working for 3 of their 4 brands. But it's encountering this formidable external challenge with tariffs, almost like running a strong race, but straight into an unexpected headwind.
That cautious neutral market sentiment we noted earlier, it perfectly captures this divergence. While analysts are certainly noting the impressive merchandising improvements, the underlying brand momentum, the focus remains acutely fixated on that revised full-year operating margin guidance and the significant Q3 gross margin contraction due to tariffs.
Yeah.
That initial after-hours dip and subsequent recovery, it truly highlights this ongoing push and pull. Operational strength versus these external headwinds. Investors are weighing the core business health against that tariff burden.
What's truly fascinating here is how management is framing this, constantly stressing their reinvigoration playbook, the cultural reset at the company, emphasizing those consistent comp sales gains. Yet the market is keenly watching the immediate financial impact of these tariffs, especially as other U.S. apparel retailers are also grappling with similar broad margin pressures.
Right.
It's a real test of whether their internal strength can truly overcome these external forces.
Exactly. The key catalysts you'll want to monitor moving forward. Obviously, the upcoming Q3 results. Critical for validating their sales and gross margin path given the tariff impact. Then there are the milestones in Athleta's product and marketing relaunch under Maggie Gower's new leadership. What specific changes will we see? How quickly will it resonate?
Right, the Athleta turnaround.
And of course, any further developments in trade policies that could significantly impact the cost curve. The continued success of things like the Better in Denim campaigns will also be important for sustaining that brand momentum. This multi-year arc for Gap Inc., it really hinges on sustaining positive comps at its core brands while Athleta recovers. With sourcing diversification and platform technology serving as critical structural levers for future margin improvement, it's a dynamic situation. It rewards patience, close observation.
Okay. Now, for something a little different, purely for entertainment, mind you, to get you thinking like a hedge fund analyst pitching to an investment committee. Our This Is Not Financial Advice segment.
And let me just reiterate, this is for illustrative purposes only. Always do your own research. Consult with a financial professional. We're just having some fun here, exploring possibilities.
Absolutely. With that very important disclaimer, I said, consider this. Gap Inc. is guiding for China exposure to drop below 3% by year-end 2025. No single country over 25% by 2026. Management also explicitly stated they expect to mitigate the full tariff impacts over time. potentially leading to long-term operating margin improvement, even hinting at that return to double-digit margin long-term. This suggests there's significant underlying earnings power just waiting to be unleashed once that tariff headwind finally dissipates.
Okay. So given this, an outrageous but plausible trade idea could be something like a long-dated, out-of-the-money bull call spread on gapping equity, maybe expiring in late 2026 or early 2027.
Okay, break that down. Bull call spread.
Right. Think of it as a relatively low-cost, high-leverage way to bet on a significant stock price increase over the next, say, year or two. But with a built-in cap on both your potential profits and losses, you would buy calls at a strike price slightly above the current level and simultaneously sell calls with a higher strike price. This strategy limits both your upside and your downside, but it makes the entry cost significantly lower than just buying outright calls. Gives you more bang for your buck on a directional bet.
So the bet here is basically that the market is currently overly fixated on the near-term tariff impacts and the Athleta drag, maybe underestimating the long-term strategic execution.
Yeah.
Creates an opportunity for investors with a longer time horizon, perhaps.
That's the thinking.
You're leveraging the optionality, the chance for the company to successfully execute its sourcing diversification, Athleta's turnaround under new leadership, and those technology investments, all driving that long-term operating margin expansion, potentially pushing the stock price significantly higher over the next 18-24 months.
Exactly. But this strategy requires and conviction, really, in management's ability to execute on those strategic priorities, allowing that underlying margin expansion to materialize as the tariff impact annualizes and mitigation efforts take full effect. It's a play on the company's resilient core, eventually overcoming the external pressures.
So there you have it, Gap Inc. Q2 fiscal 2025 earnings call. A company with a clear playbook, successfully driving 3 of its 4 brands, while navigating pretty significant global trade headwinds and embarking on a crucial turnaround at Athleta. It's a dynamic and multi-layered story.
It really is, and the story's far from over. The coming quarters will really test their agility, their execution on those mitigation strategies, and the Athleta reset. The potential for underlying operating margin expansion is certainly there, but the journey through the current environment is going to be incredibly dynamic, demanding continuous strategic adjustments, I think.
Remember, this is all about staying informed and thinking critically, looking beyond just the headlines. What aspect of Gap Inc.'s quarter stands out most to you? We encourage you to continue exploring the details and connect these dots for yourself.
Thank you for joining us on the Deep Dive.
And always remember, the information discussed is for educational purposes only and definitely not financial advice.
Until next time, stay curious and keep those ears to the ground for the next big market mover.